You are watching Trading Day. Jerome Powell and other major central bankers are in Sintra, Portugal. And this morning, Fed Chair Jerome Powell acknowledged that the latest set of economic data, particularly around inflation, has been confirming that the country is on a downward path, but emphasized that officials do need more evidence before lowering interest rates. For perspective, let's bring in Gennadiy Goldberg, head of U.S. rate strategy at TD Securities. Gennadiy, thanks so much for being with us. Here we're really in the finessing part of dealing with inflation, right? Getting from 3 to 2% is kind of the hardest battle here, and it's different, right, for every country. In the U.S., they didn't have that flare-up. Did Jerome Powell's comments do anything to move the needle for you in terms of when you think that first rate cut might be?
To be honest, not really. I mean, it was a little bit of the art of saying nothing at the moment. The Fed still got a couple of data prints before the September meeting. I think July is not really on the table. It's just too soon. We don't get enough data by then. We've got 3 more CPIs, 3 more payroll reports, all before the September meeting. And I think that meeting is still live, and that's why the market pricing didn't move all that much.
When do you have the first cut penciled in?
So we've got the first cut actually in September. We do expect that to be the first time the Fed actually takes rates lower. We expect a 25 basis point cut, then another one in December, and then really quarterly thereafter as the Fed kind of takes rates a little bit lower from here.
You have to think about politics, I think, as well, how that decision might be politicized if it is in September going into a very contentious election. What questions are you getting on the desk about how politics are going to factor into this?
That's a great question. I mean, we're certainly getting lots and lots of questions about whether the Fed can actually start a rate cutting cycle, a couple of months before the election. And I think given how much they've telegraphed this move, given that we've been talking about rate cuts for the better part of a year at this point, I certainly think they can deliver that 25 basis point cut. If the conditions are met, if inflation is starting to move lower, moving rates from 5.5% to 5.25% is not really going to be super impactful. It will send certainly a signal to markets, to consumers, but it really won't impact anything on the election side. Let's be honest, whatever the chair does will be viewed by one side or the other side on the political spectrum as being detrimental to them. So they're kind of between a rock and a hard place at the moment.
Since the debate last week, bond yields have moved up on that U.S. 10-year, and the thinking it's because of a presumed outcome in which Donald Trump wins, Republicans win, and there is more spending. There's more spending, there's more Treasury issuance, and thus yields go up. Is that really what's going on? Is the market starting to price in an outcome?
I think the fact that we've seen a very large bear steepening in rates, so rates have moved higher, the curve has steepened, all since that Thursday debate, tells me that there is some part of the market that is actually pricing in, an outcome where Donald Trump becomes president again and the Republicans actually control both the House and the Senate. That's really the more extreme outcome for markets here. It does entail higher deficits. I think both parties actually will push deficits higher over the next couple of years. That's not really in question. But if you look through the election scenarios, you look at all the various combinations that you can have, the likelihood of higher deficits in a Trump second term with a Republican House and Senate does actually go up. And I think the market's pricing that in because the odds, at least according to some of the betting markets, have certainly gone up of a Trump victory.
Now, you mentioned that bear steepening. The yield curve is the least inverted that it's been, the 10-2s, in almost 5 months. And while you might think, well, that's good, but historically, right, doesn't that predict or come before recessions? And I referenced that Atlanta Fed GDP Now indicator is now only showing 1.7% growth, the lowest that it's been flashing all year. Are we going to start talking about recessions again?
I think we're talking about a growth moderation. And Chair Powell was asked about this at Sintra as well. And he basically said, look, we're in a very good spot in terms of the macro economy. I don't necessarily think the Fed needs the economy to slow substantially to cut rates. What we're talking about right now is really cutting rates to decrease the amount of tightening that they're doing. They're not really looking to lower rates by any I would say to any particular extent. They're just looking to take back some of this tightening that they've done. If the economy starts to falter, they can certainly cut rates faster, and they've all told us that. But at the end of the day, I mean, if the economy is still going okay, 1.7% is right around our potential GDP, which is anywhere between 1.5% and 2%. That's right in line, right? So what we're really watching is less so the growth side of the equation and more so the inflation side. And if that continues to behave, we get 3 more prints, I certainly think a September rate cut is in the offing.
So let's put this in a global context, because I think a couple of months ago, we weren't sure that the Fed would be able to cut at all because inflation was so high. And then we looked at it against Europe, and we looked at it against Canada. And it seemed like, well, they're definitely going to be in rate cutting mode. And then Canada's inflation surprised to the upside. Europe's core inflation was stubborn. And this is, I guess, calling into question just how wide is that rate gap going to be? How do you think about that?
So I think about it in terms of every central bank doing what it needs to do. And you mentioned, the different unemployment targets, the different inflation targets across regions. That's still the case. I mean, every country has their own idiosyncratic issues that they have to deal with. I think for the U.S., at least at the moment, the Fed's in no rush, right? They've told us as much very clearly that they're in no rush to cut rates. But we know from a longer term perspective, they want to be cutting rates before the economy actually slows down, before things really weaken. And that's going to be relatively preemptive. So there is I would say, a limit to how wide that differential can get, but that's not to say that the Fed can't be the laggard in the global rate cutting cycle. It's certainly what we expect. We expect them to come in a little bit later than most other G10 central banks. But 3 to 6 months is not really a substantial deviation from a historical perspective. You've certainly seen wider gaps in the past, and you can see them again.